Okay. Good evening, investors and partners. Welcome to ASK Growth quarterly update call. Now, talking about growth, growth is one of the oldest PMS strategies running in India at this point of time, with a track record of more than 2 decades. Just to put things in statistical perspective, 1 crore invested in 2001 has become 47.9 crores today. Today we have Mr. Sandip Bansal with us to take it forward. Now, just talking about Sandeep, he brings in the rich experience of more than 2 decades with 15 years in equity markets. He has been associated with firms like SBI Life Insurance, UBS, Kotak Institutional Equities. He is a CA and an MBA from IIM Institute as a qualification. So over to you, sir. Thank you.
Yeah, thanks, Sunny. Hello, friends. Thank you so much for sparing time on a Friday afternoon with us. Briefly running through the market outlook first. Sunny, is the slide changing?
Yes.
So the slide has changed, right?
So it is, yes, it's on the first slide.
Oh, so it has not changed. So let me try again.
Yeah.
Let me just try again resharing the slides because it is not changing. Sorry about that. Let me just retry this. Has it changed now, Sunny?
We are still on the first slide.
Okay. So let me now try sharing the screen rather than yeah, so let me now try sharing the screen because somehow, the slides are not changing.
No.
Yes. It's now visible, hopefully, right?
Yes, yes.
Yeah, sure.
Very much visible.
So friends, if we look at, markets this year on a calendar year basis, what we see is that CYTD, Indian markets have given us 7% kind of returns. This data is as of 18th August. But it is not that India is the best performing market. There are many markets, mostly in Europe, which have actually fared far better. It is just that on a longer term basis, India has given better returns on a 3 to 5 year basis, while this calendar year, there are global markets which have done better. So equity as an asset class generally, seems to have done well. It is not alone the Indian markets. Indian markets on a financial year basis, Nifty would have given a return of around 10-11%. Mid caps have fared far better, 2.5 times that return, and small caps have done even better with 3.5 times that return. Now, talking about global markets, one of the key reasons for the global markets doing well is inflation coming off in an abundant global liquidity scenario. This chart looks at inflation last year versus July of this year across various key geographies. So, if we just take the example of the US, inflation has come off sharply from 8.5%, let's say, to 3.2%. Recently, we have seen some spike in, let's say, vegetable prices, wheat prices due to, some blockages in the global trade. And also because of crude, inching up or spiking. Having said that, it does seem that, the worst of inflation is behind us, and some of these recent issues could be transitory. And similarly, what we have seen is that, the Fed has paused, and, that has kind of led to a good strength in equity as an asset class globally. Talking about India, Indian markets have also done well. This is a chart of Nifty 1 year forward, rolling forward PE chart, price to earnings ratio, which typically we look at in markets to gauge of how pricey or cheap the market is. Versus the long-term average, which is more like 15x, currently we are more like 20x. So below this would be cheap and above this would be expensive. So we are somewhere around, one standard deviation mark. So, there is an argument the markets are not cheap. But if you look at long-term trajectory, the valuations itself seem to be on a rising trend. And one of the key reasons for that is that the structural part of the market, or the part of the market which is valued relatively highly, that has gained a greater proportion in terms of composition of the benchmark. So this average itself over a period of time has moved up. And to that extent, the premium that optically looks might not be, actually as high. The key reasons for the Indian markets to go up, in addition to inflation maybe peaking out globally and interest rates now being paused, hikes being paused, is the fact that corporate profitability in India has been quite solid. So this line is basically the market cap of, let's say, the entire market, and these blue bars are corporate profitability again of the entire market. So we've seen a sharp rise in corporate profitability, and concomitantly we've seen a rise in market cap as well. And going forward, how do we look at earnings? So earnings, are expected to grow at a 15% CAGR over the next couple of years. Obviously, the rate of growth was far higher from the COVID lows, but now still it is likely to be in a good mid-teen kind of a range, which is again going to be amongst the best globally if we look at large markets or large economies. The Q1 results, which just got recently completed, the results were in line to slightly better than expectations. Some of the key takeaways were that the banking sector has delivered a very good result. What we are seeing in the banking sector is that NIMs, probably have likely, which have improved, are kind of likely peaked out. But, loan growth is likely to continue to remain good, and credit costs or the NPA cycle is likely to remain benign. On the consumption side, what we've seen is that, volume growth has not been that good, except autos and maybe a few premium consumption items. However, it seems that demand has been kind of stabilizing. Overall, the export sector has actually fared less better compared to the domestic sectors. So globally linked sectors like chemicals, IT, metals, they have had some kind of a slowdown. The reasons for that is that, in the chemical sector, we have seen that there has been a slowdown in demand, plus, there has been a destocking globally, and China has actually, dumped material globally because the reopening in the Chinese economy has not led to as much a robust demand as was anticipated. Similarly, we've seen muted results from the IT sector as well as the metal sector. The OMC sector or the oil marketing companies have delivered a very good performance in this quarter. Coming to the capex linked sectors, there's been slight divergence. Let's say, while on the cement side we've seen good volume growth, while margins are still not back to the high levels, but on the capital goods side we've seen a good demand and good orders still flowing through. Now, what is the outlook from here onwards? The capex side of the economy, continues to remain good, with both the steel demand as well as the cement demand, posting good numbers. The consumer staples side, seems to be having some kind of a muted demand environment, though things are likely to improve. The global slowdown and destocking is impacting the global linked sectors. Export insecurity from China continues to be high because of the slowdown in the domestic market in China. Input cost pressures, have reduced considerably due to the fall in commodity prices. The benefit of that was seen in the margins of companies, and we are likely to see more benefits of the same going forward as well. Now, if we look at the Q1 earnings of our portfolio companies, so these are the kind of numbers that we are looking at. So on the operating profit side, our portfolio was about in line with that of the market. If we look at going forward, what we are expecting, so for FY24 overall, we are expecting that our portfolio companies are likely to deliver a better earnings growth than the market, because the second half of the year for many of the portfolio businesses is likely to be better, as we discussed that the global destocking cycle has kind of impacted growth for a few of the names. Similarly, for FY25 as well, we expect the companies to deliver a better operating performance than the market overall. If we look at some of the key parameters of the portfolio on an overall basis, so we are expecting, let's say, around a 33% plus ROCE kind of a profile for our portfolio companies. This is significantly better than that of the overall market. Earnings growth, we've already talked about, so we are looking at a 20% plus kind of an earnings CAGR over the next couple of years. In FY25, this number looks more like 15%, just because of one company, which is Indian Oil Corporation. Indian Oil Corporation is likely to post very good earnings this year, and because of the high base, the earnings are likely to be impacted next year. But let's say the 2 years combined, we are looking at 20% kind of a CAGR in our portfolio earnings. In terms of the balance sheet strength, the debt to equity profile of the portfolio continues to be solid, in the 0.1x kind of a range, while that for the market, is likely to be far higher. Overall net result of this is that, the valuations of our portfolio, when we looked at a P ratio, is higher than that of the market. So, the market or Nifty is, let's say, trading more like 20 times, while our portfolio is valued more like 26 times. But we believe that it is more than justified by the higher growth profile, the better return on capital profile, the higher free cash generation, and the better debt to equity ratio profile of the balance sheet. It is not that we are forecasting some very high numbers for our portfolio companies. If we look at the portfolio as a basket, and what kind of earnings they have delivered over the last 5 years, in the period FY18 to FY23, the portfolio has delivered an earnings growth of around 24%, versus that of around 16% of the market. So, even in the past, historically, the portfolio has delivered better earnings growth, and we believe that that is going to continue for the next few years as well. Over the longer term, what we've seen is that market returns or portfolio returns are more aligned towards returns in the underlying earnings of the portfolio companies. If we look at the portfolio construct on an overall basis, the portfolio has, 3 or let's say 4 key cornerstones. Firstly is the BFSI space. That continues to be, let's say, around 30% of the overall portfolio. Within that also, the balance of the mix, let's say relative to the benchmark, is more towards businesses that have a higher exposure to retail, or for which retail banking or retail lending is growing at a faster pace. So, there are 3 key profit pools for a lender. One is the retail pool, the second is the SME and MSME pool, and the third is the corporate profit pool. The first 2 pools are relatively higher growth, and they are relatively, faster growth as well. So, our overall exposure is more kind of leaning towards that kind of a mix in the entire BFSI space. Then around 25% of the portfolio, or around 1/4, is kind of levered to the Indian domestic consumption story, which we believe has a very long runway for growth, given our large size of population, the large component of youth in the population, which has a higher production as well as a higher consumption capacity, and the fact that our base consumption levels are really very low. So the opportunity in the consumption sector in front of us is actually a multi-decade kind of an opportunity. Within that also, within the consumption space also, we have a very good mixture of FMCG companies, companies exposed to retail, companies catering to discretionary consumption, companies catering to consumer durables, and home decor. So, this is the second pillar of the overall strategy. The third aspect is, industrials, which is kind of levered to the overall capex infrastructure and construction and engineering development that is happening in the country. So, we have exposure of around 12% in this space. The third big sector for us, and especially relative to the benchmark, is chemicals. There we have around a 9 to 10% kind of an exposure. Over here, the companies have not posted as good outcomes as we would have expected. This has been related to the fact that there was global inventory destocking, and there was a dumping of material by China. The second half of the year is likely to be far better for these companies. We believe that this is a sector which is going to have a very strong growth outlook for the next many years to come, given the global diversification of supply chains, the China plus one strategy, and also the fact that India is now focusing a lot more on import substitution. So, that is in some sense a fourth pillar. Then we have, let's say, around 12% kind of an exposure to oil and gas. And within oil and gas also, the larger exposure is towards Reliance Industries, for which more than half the valuation driver is now telecom and consumption business. And our export-linked sectors are, let's say, around only 7%. The greater risks, if we were to highlight, are more on the export side or more on the global side rather than domestic. So we are more convinced about the domestic story in India, and whether it be geopolitical risks or the risks of an elevated interest rate environment emanate more from the global side, wherein our exposure is, not very high. And then, around 4% of the portfolio is exposed to telecom. Going forward, what do we think about the markets, about our portfolio, and also, the key risks that we envisage? So firstly, monsoons have been quite erratic. We were running deficits earlier, which were then, more than exceeded in the month of July. Then August again has not been that good, and overall rainfalls have again become in a deficit. So, this has an impact on sowing patterns, rural incomes, and also on inflation. It seems as of now that, the vegetable and food inflation, is transitory, and it might not last long, though it could have some impact over the next few months, but that should be it. So, overall, this is an area which we would be watchful about. On the export side, we do expect the second half of the year to be much better. On the domestic side as well, we expect demand to pick up significantly during the upcoming festive season post the monsoons. So net, with this global destocking cycle getting over, and with domestic demand picking up in the second half of the year, we believe that things should look much better. On the global side, we are again obviously watchful of how things play out in the Russia-Ukraine war. and also the impact of an elevated interest rate environment. That has had some kind of an impact on global growth, and global demand has been impacted. We anyways do not have a significant exposure to global linked sectors, but still we remain watchful of that. Friends, this is it largely from my side. So thank you so much for your patient hearing, and would be now more than glad to take any questions that you might be having. Thanks a lot.
Thank you, Sandeep, for the detailed update on the portfolio. So we have first question that outlook on some of the stocks which were, I would say, a bit under pressure if you see last year. And if we talk about the Q1 as well, they have been little bit on a softer side. So if I talk about Divi's Laboratories, Patanjali, Avenue Supermarts, where we had seen the margin compression as well. If you can throw some light on these kind of stocks. Thus.
Sure. I will take them one by one, Sunny, and if I missed out on a name, then request you to please kind of bring it up once again.
Sure.
Talking about Patanjali, there has been a good degree of volatility in oil prices. For Patanjali, the edible oil business does get significantly impacted because that is a business which is relatively a lower margin business. Patanjali obviously continues to be in a very strong position of strength in that business, given that it is the second largest player in the overall edibles oil industry, and actually the leader in other small sub segments of the same as well. Over the last, let's say, few quarters, results were kind of impacted by volatility in the input prices. However, the other part of the business, which is the foods business, that business, which is, biscuits, ghee, honey, juices, that part of the business has been doing well. We continue to expect a very good growth over there. In fact, Patanjali is likely to be, amongst the faster growing companies among its peer set, given its size. And valuations for the name continue to be very, very reasonable. Our positive outlook on the business continues. In terms of their ability to expand distribution, it remains very high, because the distribution network is far lower compared to many of its larger peer group. As far as DMart is concerned, DMart has a business of general merchandise and apparel in addition to its grocery business. What has happened is that post COVID, the general merchandise and apparel business, has not picked up to similar levels as it was during pre-COVID. That business had suffered during COVID times, and it still has not recovered fully. The company otherwise continues to execute well. We do expect that the company would be able to set right the issues on the general merchandise and apparel side. The grocery business continues to do well. Their store potential continues to be 4x to 5x of their current number. The stock has been an underperformer, and it has been a drag on the portfolio. But we would like to believe that a large part of the pain is already behind us, and the outlook from here onwards is good. So Sunny, is there any name that I've missed?
Divi's Laboratories, if you can put some.
Right. So Divi's, what had happened with Divi's was that they had a large order for a COVID drug, and then that order, post-COVID, obviously that order went away. And so on a YOY basis, there seemed to be a big decline in the numbers. Divi's also got impacted because, the end prices of APIs were under pressure. while at the same time raw material costs went up, and also there were supply chain issues like freight costs had gone up dramatically. Some of these issues have corrected, like freight costs have come down, input prices have corrected. Some of the aspects are still reverting to normalized levels like pricing, etc. The company continues to work on expanding its portfolio of offerings. They are getting into newer products and newer areas, which is going to bring about growth. There is no uh, the business model, its capabilities, technology, processes, continues to be top class. It is amongst the leading companies in its space, and for many of its products, it is actually having considerable global market share. So from that perspective, we continue to remain optimistic about the company. Having said all of this, we anyways are in a continuous process of evaluation with respect to all our companies. And while we see through some transient macro issues, if we believe that there is any damage to the business model, to the outlook, uh, or the way the company operates, then obviously we take necessary actions at those points of time.
You. So we have one more question on Page Industries. Considering the fact that the performance in the recent past has been challenging on the financial fronts as well as the stock price as well. So considering the dream run which we had seen in the September and the December quarter last year, where they delivered one of the highest profits in the history, if you can put what's the forward outlook for the company in next 2 years or so?
Sure. No, that's a fair question to ask. So Page Industries, a number of things happened. Firstly, there has been some kind of a demand slowdown. Having said this, what we've seen is that Page Industries has actually performed far better compared to the rest of its peer group. For the peer group, actually, the damage has been far higher. So that was one aspect. The other aspect was that there was some kind of a realignment in their internal systems and hence the supply chain. That also had an impact on the numbers. Having said this, a lot of the pain has already been gone through and borne. While one cannot rule out that incrementally there could be pain for, let's say, maybe a quarter or so more. But having said that, in this space, including the overall apparel space, this continues to be, one of the best companies that has executed, both on its network, supply chain, returns on capital, as well as growth. Just leaving aside the recent history. The outlook for us continues to be quite robust, on a 2-year basis. And again, over here also, we like to believe that, the pain was more of a transient kind in nature.
Okay. One more on the performance of the APL Apollo. It has had a great run over the years. What's the future outlook for that, considering the fact that in last 1 year itself, the stock performance is around 65, 70% upside, which we have seen.
Sure. Obviously, when a stock runs up so much, uh, there are valid questions that come up that, how much more to do. If we look at the underlying business performance, that continues to be quite solid. This is a business which is delivering, can deliver 20% plus kind of a volume growth for some period of time. It's a leadership business which with a significant moat and a significant leadership advantage over its nearest peer, as well as the entire competitor group as a whole. It perhaps has 3x the number of stock keeping units compared to its nearest competitor. It perhaps has 2x the number of dealers. In this business, supply chain is a critical aspect. Because of commodity price volatility, it is very important to keep inventory levels in check and the supply chain very tight, which this company manages to do extremely well, in spite of it being significantly larger than its nearest competitor. Plus, it has a pan-India presence and can supply products throughout the country. Its innovation engine also continues to be very strong. It has brought a number of products, continues to bring and will bring in the future as well. Products that are, for the first time to be used in the country. Keeping all these things in mind, and keeping the fact that the returns on capital continue to be very healthy, we continue to have a positive outlook on the name. And, it continues to be one of the more significant positions in the portfolio.
So we have one more question on the IOC, considering the fact that we don't have too much of exposure as far as the PSU segment is concerned. So this is one name where you can explain the rationale behind it.
Right. That is true. We generally do not have large exposures to PSUs in our portfolio. In the oil and marketing and the refining side, there are a number of reasons why we like IOC. Firstly, if we look at the overall refining cycle, what we think globally is going to happen is that demand over the next few years is likely to outstrip supply of refinery capacity addition. Refining as an industry, in our view, could remain in a position of strength for the next few years. Indian Oil Corporation is the largest refiner in the country, and hence we believe that it'll stand in a good position to benefit from this upcycle. Secondly, IOC is also investing significantly in capacity addition. The next few years are also going to see an increase in its refining capacity, which will help it to benefit from this refining upcycle. Thirdly, what has happened is that the marketing margins, on the business are healthy. While obviously they were weak last year, they are healthy now. So on the marketing side also, the worst of the pain is, behind us. Just the last thing on IOC is the fact that, there is likely to be a good deleveraging of the balance sheet, because of the profits that they would be making. If I could just add one more thing is that, there is a good benefit that is also flowing through because of the cheap procurement of crude that we as a country are able to do from Russia. So, net, it is all of these things combined. The valuations for the business also remain attractive. And, for us, these were the various inputs that went into the selection of the stock.
Okay. One more on the Kotak Mahindra Bank. It has been a great wealth creator over years, but from some past years it has been struggling a bit. So why we are still holding it, and what's in next 3 years? What's the outlook for the same?
Sure. So Kotak Mahindra Bank, we are not holding in this portfolio, but within ASK we are holding it in some of our other portfolios. What has happened is that Kotak Mahindra Bank, for a long period of time, while it was relatively smaller compared to some of its larger peers, its growth rates were not as high as compared to its larger peers. In the markets, obviously prefer better growth. So that was one reason. Secondly, Kotak Group as a whole, has a relatively more conservative mindset in some sense. And hence, they don't leverage their balance sheet to that extent as well, because of which the return on equity for Kotak Mahindra Bank was also relatively lower compared to its larger peer set. So that was one of the reasons for the stock to maybe not have done that well. Plus, there were also concerns around the fact that Mr. Uday Kotak's term is likely to is expiring. As a CEO, the term is expiring at the end of the next financial year, so next calendar year, and so succession issues, and how the bank is going to transition, because he has been the face of the bank for such a long period of time. So combined, all of these three factors were the reasons. But and it always obviously still commanded a good valuation multiple relative to its peer group, in spite of a lower growth and a lower return on equity. Having said that, one would like to believe that the stock has underperformed quite a lot, significantly, and given where its valuations are, it is a very, very attractive franchise, which has its fingers in all the different pies of financial services, and which has executed very well in all of them.
Yeah. So although Kotak not part of the portfolio, but I thought it's an important stock as far as.
Sure, definitely.
Two more stock-specific questions have come up. One is on the HDFC. What's the way ahead for HDFC over a period of next 2 to 3 years?
So HDFC Limited has merged into HDFC Bank. HDFC Bank is now the second largest bank in the country. It has a significant balance size, next only to SBI. The merger and integration process in HDFC of HDFC, sorry, is going to result into significant benefits for the bank. So that is likely to play out over the next few years. So the bank as a whole has also increased its stake in the its subsidiary. So that will also benefit. The growth. So for the last 1 year or so, what was happening is that a lot of focus was there on the integration. Now a lot of focus is now going to return on the growth aspect for the business. So that is the third thing that is going to play out. On the flip side, HDFC needs to garner a lot of deposits. So the fight for deposits in the market is likely to intensify quite a lot, because when HDFC Limited was an NBFC, it could depend a lot on borrowings. Now it's a bank, so it will have to hunt for deposits. Given its large size, that is a challenge. But HDFC Bank, for the last many quarters and going forward as well, is going to open and has opened a lot more branches than what it has done historically. While the branches are relatively smaller in size, because the digital component of the banking business has gone up. But having said this, they realize that a bank branch is very important for garnering deposits, and they are really focusing on that. Uh, we believe that HDFC Bank Group as a whole, and bank especially, is a very good execution machinery in the entire business, the entire sector. We believe that in spite of its size and its leadership position in all the various sub segments of the retail lending market, especially, we believe that the a bank will outperform the overall sector credit growth. Its risk management framework has always been top notch. So it has always managed to control NPAs, and we believe that that is going to continue. And there will be integration related synergies that are going to play through. So we remain positive on the name.
So we have one more question on one of the stock, Gujarat Gas. What's the outlook for next 2 years or so, considering the fact that from last 2 years, the performance has not been that great?
Right. So Gujarat Gas, honestly speaking, has been, in terms of stock price performance, has been a disappointment for us. It has not played out as per our expectations. So what had happened was that after the Russia-Ukraine conflict flared up, gas prices went through the roof. Uh, the increase in gas prices, were the highest in history ever. Uh, Gujarat Gas is an importer of gas, which it supplies to various parts of its businesses. Let's say primarily to for industrial use. What happened was that due to the sharp spike in gas prices, the industrial demand came down. Plus, there was an impact on its margins as well. We had not expected such a sharp increase in gas prices. After that, what happened was that uh, propane prices, which, so gas prices after flaring up and staying there for a period of while, for the last few months, they've come down. But what has happened during this period of time that propane or LPG, which is an alternative fuel for gas, or LNG, those prices become relatively more competitive versus gas. So its users shifted from using its LNG to propane. So then that again had an impact on demand. So all of these combined, has resulted in volume degrowth for Gujarat Gas over the last many quarters. Uh, in hindsight, it does seem to us that we should not have maybe held on to the stock uh, for this length of time. But the price fall was very sharp, and valuations now are such that a lot of the disappointment is there already in the price. Uh, on the there are two pieces of the business which will continue to do well. One is on the domestic residential use, which is the pipe natural gas, and the other is the auto side of the business, which is the CNG side of the business. So those two businesses are structural in nature. For a large part of those businesses, it also gets gas on the administered price mechanism. So there is relatively good visibility on raw material cost, which it can pass through as well. It is the industrial piece which is the larger piece in volumes, which is a key monitorable for us.
One question on the sector specific is one sector, chemicals, where we had seen some headwinds as far as the near term is concerned. So just your views on the same.
Yes. So, chemicals, we, have a decent exposure in the portfolio. Around 9 to 10% is chemicals. It is primarily, in two stocks. In the chemical sector, there were two issues that happened. One, because of the slowdown in demand globally, there was a destocking cycle, and hence, the demand growth for the chemical companies were impacted. Uh, the second thing that happened on the supply side was that China post reopening, the domestic, it was anticipated that the domestic demand in China is going to increase significantly. Unfortunately, that did not happen. And, Chinese suppliers, ended up selling their material at a far lower cost globally. So this in turn impacted the demand of the goods supplied by the Indian company. So net, prices took a beating, demand took a beating. Uh, it seems that a lot of the bad news and a lot of the uh, bad demand, or the lack of demand, or the lack of pricing has already played out. Can it last for a quarter or more? The answer is yes. But we do think that the second half of the year is likely to be quite good. Also, the structural story for the chemical sector remains very much intact. It is going to be driven by global diversification of supply chains, China plus one, Europe plus one, and the fact that India is focusing a lot more on import substitution. So given the large runway for growth, given the fact that we as a economy and as a country are focusing more on manufacturing, and given the fact that every large country has seen the development of a large chemical sector, we believe that the structural outlook for the sector continues to be very robust.
So there are no more stock specific questions, but just wanted to put a light on that. Last year we had seen that the earnings growth of the portfolio had been decent, and we didn't see that materializing into the stock performances. This year also we are expecting the earnings growth to be very healthy at about 24% or so. So if we consider the investments from say next 3 years, 4 years perspective, what would be the expectations? Do we see the expansion as far as the valuation is concerned, considering the underperformance of the stock prices in the last year? So
that is true that, while the earnings growth have come through, we have seen some kind of a derating in the valuation multiples of, the stocks in the portfolio. This has happened across sectors. So, there are multiple reasons for the same. One reason is the fact that in an increasing interest rate environment, we generally see what is typically known as growth stocks. They kind of underperform versus what is typically talked about as value stocks. And we have seen that money has in the market moved from the growth style of investing to the value style of investing. We believe that there is only one way of investing, which is in identifying good growing businesses which generate good returns on capital. And ultimately, over the longer term, we have seen that market returns kind of align themselves more towards the underlying earnings growth. But these are phases in the market. These things happen in the market. Not to say that they are right or wrong, but the fact is that this we just have to focus on the underlying earnings growth and the earnings potential of the companies. And multiple re-rating, de-rating are different phases. Honestly speaking, it becomes very difficult to catch these phases. It is better, we as long-term investors would like to identify good businesses and hold through them. Whenever we believe that there is a structural damage to the earnings or to the earnings potential, then obviously we act and make a change. It is up to the markets to recognize the earnings. We have seen in the past as well that sometimes the market places a value which is significantly more than what the earnings should demand, and sometimes it places far less. But ultimately, they catch up with each other. So that is the expectation with which we invest. But yes, it is true that in the past, this is in the recent past, a year and a half, this is what has happened, that while earnings have come through, stock prices have not necessarily reacted in the similar fashion. But we believe in the earnings potential of the companies that we own. We also believe that, see, what has happened in the last 1 to 1.5 years is that the earnings have also grown. Few of the stock prices have actually remained flat or could have come down as well. And at the same time, there has been a time correction as well of 1 to 1.5 years. So already a lot of the significant de-rating, if we were to say, in many of these stock names have already taken place.
Okay, Sandip, thank you so much for the great insights on the portfolio, covering on the individual stocks as well as the sectors as well. So we don't have further more questions on the same. I would like to thank participants and the investors as well as the distributors for joining in the call. Thank you so much, Sandip, for the same.
Yeah. Thank you so much, everyone, for your patient hearing. Have a very good weekend. Thank you, Sunny.